Welcome back to our Earnings Central. At a time when many banks, as we just saw, are struggling with asset quality and high slippages, especially in unsecured, Bank of Baroda has actually reported about the best asset quality in a decade. The loan growth at 11.6% is a little slower than peers like ICICI Bank and HDFC Bank. But let's discuss the fine print. Joining me now is the Managing Director and CEO of the bank, Mr. Debadatta Chand. Mr. Chand, good morning and thank you very much indeed for joining us. Well, let me start with the asset quality. Let me start with the asset quality, which is quite stunning. The slippages are, I think, lowest in 3 quarters. Can you tell us the breakup? Where did you see any pain in unsecured, for instance?
No, the asset quality, as you see, Latha, actually one of the best quarter we have. Particularly, there has been a good recovery out of written-off accounts. So that supported the other income also, if you see the numbers therein. So in terms of the slippage, our normal run rate is roughly around 2,700-800 crore per quarter. And in case you see last 2 quarters, the slippage has been almost at the same level.
Yes.
So in terms of any, again, 70-80% of the slippage would be account less than 5 crore. Okay. So in terms of the quality of the book and the fresh slippage, I don't think will exceed the run rate going forward. That is what the expectation at this point of time. Okay. As far as unsecured personal loan is concerned, yes, as I said, I talked to when the market in last September 23, we clearly said that we are going to moderate the growth on the unsecured personal loan. And that has a positive impact in terms of the fresh slippage now. And the fresh slippage this quarter is hardly around 200 crore out of unsecured personal loan. But let me again tell that the book has been much better as compared to the book we had earlier. So I'm not anticipating any elevated slippage out of the unsecured personal loan book. Even if so, it will be very insignificant for my book as a whole in that matter. Okay, that's good to hear.
But you just referred to recoveries. Can you give us an idea of, what is the expected, what was the recovery and what is the expectation for the full year?
See, particularly if you look at the item that the recovery of TWO account that we have given for this quarter, our normal run rate is something around 750-800 crore. And this quarter it is almost like 2,500 crore because we got recovery from a couple of good accounts, which was one was particularly in the NCLT framework. So in that scenario, if you look at my normal run rate also, we are fairly like you are looking at the GNPA trending downwards for last many quarters now. The net NPA position is improving. We are giving on the asset quality, we are giving 2 ratios, which you are again coming true for quarter to quarter. One is a slippage ratio. We want to maintain the slippage ratio between 1 to 1.25. At the same time, the credit cost that we said will maintain below 0.75, and this quarter it is 0.65. So fairly, if you look at the parameters of the asset quality, we are fairly balanced. And the normalized kind of a slippage and the normalized kind of the recovery would continue to be there for the book.
No, I take all that. I'm just saying that since the recoveries have been stunning, is there a number you can guide for the full year? Since you still have a lot of NCLT accounts.
Yeah, we anticipate to have a recovery target of 12,000 crore for the full year.
Okay.
And at the same time, containing the slippage somewhere around 9,000 to 10,000 for the full year.
Okay, that's good to hear. So in net you are gaining. Let me come to the interest margin. Your deposits have obviously been slower at less than 10%, 9% odd. Do you see that margins can still be under pressure? Are you expecting that deposit cost can still rise?
Let me give the full context of it. Like we had given a deposit guidance of 10 to 12% earlier. And Q1 and Q2, the growth has been lower, obviously. So we calibrated the deposit growth to 9 to 11% now. And consequently, we revised the advance growth also from earlier 12 to 14 to 11 to 13. The precise reason for this is with regard to how to maintain the margin therein. And if you look at the margin that we have achieved this quarter is 3.10, which is the lower band of 3.15 plus minus 5 BPS. Even if the impact of the penal interest and charges has been almost 5 BPS. So in a scenario like that, our efforts to maintain the margin going forward, that's the key primary one of the objectives that we are running by doing a trade-off between the growth and the margin. So we continue to maintain the same margin guidance, both 3.15 plus minus 5 bps. And I think the kind of a asset liability management, we can still maintain that. Saying so, there are two assumptions that we forecast going forward. As you see, globally, there has been moderation happening on the asset pricing and also liability pricing. India, I think it has started now in terms of the regulator changing the stance now. The system liquidity is better month to month as compared to the earlier months. In that scenario, we still expect some kind of a moderation on the cost of deposit, maybe towards the late Q3 or the early Q4. And if that happening, I think we'll be in a position to maintain the margin guidance of 3.15 plus minus 5 bps.
No, at 3.15, you will actually do better than what you have done in the second quarter. But right now in the third quarter, deposit costs are still higher. I mean, are you likely to pay a little more? Can they increase even from current levels?
To my view, that may not be the scenario. I think as far as the economy is concerned, the deposit rates have peaked out. So many of the banks are running the festive campaign, and post-festive campaign, I believe there will be moderation in the cost, particularly in the peak rate side on the deposit.
Okay, that's good to hear, at least from a banker's point of view. But what is your percentage of loans tied to EBLR? Because if the rates indeed get cut, then there can be a problem for banks, at least for a brief period. What is your bank's percentage of loans tied to external benchmarks?
See, my MCLR book is almost 47% and EBLR is 33%. Right? So there are a couple of scenarios. Many loans are tagged with the EBLR. So if there is a repo rate cut, like after 3 years, you can still reset the spread. So we'll just see how to maintain the margin going forward, because there is a lag in terms of the advance pricing and the deposit pricing that we see. I mean, that's there in the Indian market. But I think banks will be in a position to manage asset liability in a manner where they will protect the margin.
Okay. Yeah, I take your point that you will be able to reset, but and not everyone is betting that a repo rate cut is coming anytime soon, given the food inflation. Let's look at the advances growth. Where do you see growth picking up? I mean, you have done as well as the system, but it is still slow at 11.6. What is the year-end expectation of loan growth, and which sectors do you see demand?
Let me slightly give an update on this 11.6%. My domestic credit growth is 12.5%. And we said earlier we want to moderate on the international book, and there actually the growth is around 6.4%, leading to the global book at 11.6%. Otherwise, the growth has been very strong as far as the domestic book is concerned. Within the domestic book, again, we maintain that we'll grow higher than this. There are the components where we want to stick to our guidance that the retail continue to grow higher than 20%, which has been there for many quarters now. The agri and MSME, which is almost at 11%, we want to grow at 12 to 14%. And mind you, again, we're getting into the busy season 2 quarters, Q3 and Q4. So I believe the agri and MSME would be higher than the earlier quarters in terms of the growth. The only keeping the overall guidance at 11 to 13, and the only book which can slightly see a change is the corporate book. And the element which again, because I have a very primary objective of maintaining the margin also, and the book which can see some kind of a realignment can be the fine price book. Obviously high quality, but fine price book. So with this, I think we'll be growing higher in segment where the economy wants, I mean, the productive sector of the economy wants the money to flow in. So there the growth would be significant. Corporate book, particularly the refi deal or the fine price deal, we may realign based on the growth guidance. International, as you said earlier, because that has 2 impact on my book. On the international advance, one is a global credit deposit ratio it impacts. At the same time, the global NIM also it impacts. So we announced earlier we want to moderate that. We have moderated that. Because of that, the overall book is slightly looks 11.6%. Otherwise, the domestic book, the growth is quite strong.
Fair enough. Very quickly, any problems that you may have, any lingering problems with that Bob World issue you all had 2 years ago? Are all that sorted out?
Yeah, that's long before it is passed now. So
okay, fine. No spillovers into the P&L.
No.
Okay. The final question I wanted to ask you is on capital. The market has been kind, well, not very kind to banks, but you could use this excellent results to raise capital, will you?
As earlier also we said, as far as equity is concerned, bank CRA has been quite robust for many quarters, many years now. And the new investment accounting also putting a lot of money into the AFS reserve and pushing up the CRAR in the matter. So in that scenario, we do not have any plan to raise equity, although I know price-wise, index-wise, market is very good at this point of time. But we do have mandate from the board, which we have announced to the market, to raise 81 and tier 2 to the extent of 7,500 crore. And as on today, we have not raised anything. Obviously, for next 2 quarters, Q3 and Q4, we'll be raising this money.
Okay, well, there are, one of the quandaries of market is that when it is kind enough to give you the money, you don't need the money. When you need the money, the market is not very kind. But,
Absolutely.
Just the final point on Reserve Bank regulations, draft rules that are expected. If the LCR rule comes, what will be the impact on your bank? And if the project finance draft rules are made permanent, then what can be the impact on the bank?
So coming to the project finance, although we do have back of the envelope calculation, but we are not announcing to the market. So we're just waiting for the circular to come in, and thereafter we'll announce that, or the impact and all. As far as LCR is concerned, that's a real, because liquidity LCR is one of the very important parameter vis-a-vis the market. So currently we are maintaining almost 123% LCR. In case the draft guidelines comes into being, then the impact would be 12 to 15%, right? But our normal, the guidance is to maintain LCR something around 115% to 120%. So a scenario where the circular is coming into effect, then possibly we have to slightly improve HQLA, which the bank would do at that point of time.
Okay, well, that could have a margin impact, but we will discuss it when it comes. Thank you very much, Mr. Chand, for joining us. That's a very confident Mr. Chand telling us that they are going to keep their asset quality and perhaps even improve it. Margins at 3.15 plus or minus 5 basis points. That's a very encouraging set of guidance. On that note, we wrap up on Bazaar. After a break, Chartbusters.